Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
That core PCE figure, which came in bang in line, 0.2% increase following a 0.3% the prior month. It was revised downward for the prior month, 0.2%. Personal income and personal spending, that's where it gets pretty interesting to me. The idea that you could get an upside surprise on both, particularly personal spending, 0.6% increase versus a 0.5% increase expected. And real personal spending increasing 0.4% versus a 0.2% expected. And it was actually revised upward in the prior reading as well, Anne-Marie. It seems like people keep spending, and that has been the engine that keeps on giving to the American economy.
People keep spending. Jobless claims yesterday, very strong number. And now when it comes to PCE, bang in line. So what is there actually, you look at the data like this, what is there actually to worry about? When I do see spending, though, increasing, I do wonder how many people are like members of my family who went out concerned about the tariffs and are continuing to spend now. And they are concerned about the holidays coming up and they don't want the prices to go up. So they're willing to go out and spend a ton now. I guess it remains to be seen.
Yeah, that's one reason why people are listening to earnings. Former St. Louis Fed President Jim Bullard joins us now. And I am so excited to speak with you, Jim, because right now I'm looking at all of this data that suggests a really strong U.S. market, a really strong U.S. economy, people continuing to be able to spend and their incomes rising. What about this picture makes you think that the Fed needs to be cutting rates more aggressively?
Yeah, thanks for having me. So these numbers look to me like they're consistent with what markets were expecting. I think markets have a reacceleration hypothesis, and I'm sympathetic with that. So I do think the economy will be in pretty good shape for the rest of this year and into 2026 as some of the new administration policies come online. On the inflation side, there was no surprise here. So that seems to be very consistent with the committee's story that they'll be able to look through inflation and then expect it to fall in 2026. So I think this leaves everything on track to have further rate cuts during the next two meetings of the FOMC.
Just to put this into perspective, this is what the market was expecting. And so there is this rally across the board as people say, OK, the Fed can keep cutting, even though you are seeing this strength and potentially reacceleration, Jim, as you were putting. Yet year over year, core PCE, that key metric that the Fed looks at, is at 2.9%. It's not climbing. It might even be going down to 2.8%, but it's still almost a full percentage point above 2%. Is there a feeling that it just isn't really important to get it down to 2% that quickly, and so you can look through that?
No, they do want to get it down to 2% over the next 2 years. So you want to asymptote into 2%. I would say not go very quickly to 2% or go under and overshoot. So I think, usually the way this is thought about is that you want to gradually bring it down. I think the committee's on track to do that. And so that part looks pretty good.
So is the committee almost looking through inflation? Have they been given the green light by the Fed chair to look through if there's going to be any hot prints upcoming when it comes to inflation?
Yeah, I do think that the chair at Jackson Hole very much signed on to the idea that any inflationary effects coming through the tariff channel would be smaller than previously anticipated, and they're coming later than previously anticipated. And so because of that, this is basically a look through. So even though you say, President Barkin said, well, it's not getting any better, for those that thought there was an important tariff component to inflation, that part should go away since that's a one-time effect. And so that's giving the committee confidence that they can go ahead and get to closer to neutral. They'll still have still be a restrictive policy, still putting downward pressure on inflation, but not as intensely as what they're doing right now.
Well, when it comes to inflation, we heard from Governor Myron almost insinuate, not right now, but maybe in the future, the Fed should actually have more of a range in terms of their target. Could you see the Fed moving towards that, maybe targeting 2 to 3% instead of just 2% across the board?
Yes, a classic issue in inflation targeting. The U.S. has come down on the side of just having a target. It's simpler communication. It doesn't leave ambiguity around having a range. One of the problems for countries that have had ranges is that, the top of the range then becomes okay as opposed to the midpoint of the range. So it can be interpreted as slippage in your commitment to keep inflation low and stable. And households do not like the inflation. So I think it's incumbent on the Federal Reserve to make sure inflation stays low and stable.
Jim, I'm trying to get a sense of how a data-dependent Fed deals with the potential of not getting data. Next week, we're supposed to get the non-farm payrolls report on Friday, October 3rd. Ostensibly, that could be after the government shutdown, where we do not get that data print. How problematic would that be for the Federal Reserve, given how balanced right now a lot of people feel the risks are?
Yeah, well, it's disturbing to not get as much data as you can on the state of the economy, and so that would be a concern. But the Fed has managed through that in previous episodes around government shutdown. So I think it's manageable, but it's not an ideal situation.
It feels like a really messy moment because not only are there questions about the integrity of the data, when we get the data, which data to look at, what the data is measuring, but there are these sort of sea changes that are overlaid on top of it, whether it's different areas, different income earners that are earning a lot and able to spend, lower income workers that are feeling the pinch of inflation and not seeing the same types of labor gains. I just wonder if the Fed should think of a new paradigm, a new benchmark to understand exactly what the optimal employment level is and how they should weigh these two risks.
Yeah, I do think it's a good time to review our models and think about how are we going to do this over the next decade? Could we do better than where we've been? I think we've been more or less preoccupied with the pandemic and the reaction to the aftermath of the pandemic, but that's pretty much behind us now. So now would be a good moment to really do a thoroughgoing review of how the Fed operates and how the models work. I guess one thing I'd like to do is have I'd like to do what other central banks sometimes do is have a parallel process where you have a new model getting ready and run that in parallel and then have a cutover point at some point in the future where you actually switch to the new model. So I think we could do things like that, and that's maybe something to consider at this point.
Governor Lisa Cook is warning, her attorneys are warning that the removal of her could cause chaos and disruption in financial markets. What do you think the reaction will be in financial markets if she is removed?
I think that the court will insist that she gets due process for whatever charges have been made against her, so that that would prevent political partisans from just making charges against members of the committee without having to prove those charges, and then calling that cause and allowing people to be dismissed from the FOMC on that basis. So I think that the people on the Supreme Court will make the justices will probably come down in some way to protect that due process clause.
Stay with us. More Bloomberg surveillance coming up after this.
Bloomberg's Michael McKee joins us from Washington with a very special guest. Mike, I'll throw it to you.
Well, thank you very much. Joining us this morning, Richmond Fed President Tom Barkin here on Bloomberg Television and Radio worldwide. And on radio, they can't see it, but on television, people could see you have a bit of a bandage on your head. You just had one of those older people's kind of operations.
Yeah, there's no truth that it was what happened in the last meeting.
All right. speaking of the last meeting, we came out of that believing that, or at least Wall Street, that you're going to cut rates again in October and maybe in December. But since then, we've gotten some numbers that show GDP is hotter, inflation is still running hot, and the jobless claims numbers suggest companies aren't laying anybody off. So should we have less confidence in the path going forward?
Well, I don't think you can mark to market the next meeting every week, even though that's what the markets do. I mean, let's see what happens on the unemployment side. We'll get some important data in a couple minutes here on the inflation side, and I think we'll get there when we get there.
Well, the majority seem to believe, at least according to what the chairman tells us, that inflation is going to be a one-time rise in the price level. Then overnight, we got a bunch of new tariffs, as you just saw, on a lot of different things from the president. How much confidence do you have in any kind of inflation forecast at this point?
Not much. I mean, what I definitely see happening is there are cost increases that suppliers want to pass on. There's no question about that. And tariffs are a big part of it. But you could put health insurance and other places, other costs in there, too. But those costs are going to attempt to get passed on to a consumer who's frankly exhausted of price increases. And so, we're seeing a lot of trading down, branded to private label kind of choices. But we're also seeing people trade off. And it wouldn't surprise me at all if people who are forced to accept certain price increases, therefore don't buy something else on the other side. And that's your classic relative price trade-off. And that may mean that you won't see as much broad-based inflationary impact as you'd see, price increases on particular items. We'll see.
And yet you get PCE in an hour, and basically you've already calculated the numbers. Inflation's not moving in the right direction. So can you still justify, or how long can you justify cutting rates in that environment?
Well, we have inflation moving in the wrong direction. Unfortunately, we also have unemployment moving in the wrong direction. And that was the backdrop of the last meeting. You have to ask yourself, how are the risks still the same as you saw them 2, 3, 4 months earlier when you had unemployment in the right direction and inflation in the wrong direction? My overall thesis, though, is that while it's not, ticking in the right place, the downside is relatively limited. I see the inflation downside is limited by this customer pushback that I just talked about. Also productivity, which I think is, we're seeing that at real scale. And so that means there's less pressure to pass costs on. And then on the unemployment side, obviously labor supply is dropping at the same time as labor demand. And that's keeping the unemployment rate, relatively balanced. And that's the combination of immigration and revocation of temporary status. Also, our generation, Mike, which is leaving the workforce. I mean, you're seeing 1.3 million more people over 65 out of the workforce every year. And so you've got less labor demand, low hiring, low firing environment, but you've also got less labor supply. And that probably means that the unemployment rate increases are going to be relatively limited.
Well, at least you and I are still employed as of today.
We'll see how this interview goes from there.
You suggested that companies in your district are beginning to feel a little bit better, or at least some of the uncertainty has come off of their planning and their thinking. Are these kind of big new tariffs that we got today just going to change that mind? Has the idea that ongoing tariffs and ongoing disruption are going to be part of this administration and economy, is that in their planning?
Well, I've been describing it as a fog that's created uncertainty. And I definitely think in the context of the last couple of months, the fog has started to lift. Businesses don't know exactly what the tariff will be on their sector necessarily, but they kind of have a sense of the range. People aren't really following the news every day, the same way they were back in April. And a lot of businesses I talk to say, look, I've just got to do something. I've got to take action. I can't be on the sidelines forever. So I am seeing people more in the game. Now, if you're in a particular sector where you see a new announcement, of course, that's going to set you back. And so, what I say about businesses in general is not true of businesses in every sector. And so there's sectors with a lot more clarity and sectors with a lot less clarity. And that's, I think, just going to be part of the game here.
This morning we had an investor on who basically said markets are rising because of the idea that a year from now rates will be substantially lower. Is that the right way to look at it, the wrong way to look at it?
Oh, I wouldn't know how to think about, how markets ought to rise or not rise. I mean, we're very much focused on trying to land the plane here and balancing inflation and unemployment. As I said, I think both of them have ticked in the wrong direction, but on the other hand, the downside is limited, and we're just going to have to, adjust our stance as we learn more.
Well, where's your dot? What are you thinking in terms of the next couple of meetings and then for 2026?
Well, I really like the dot process for me because it forces real integration of your thinking in terms of where you think the economy is going, where you think policy is going. But I don't have it as a forecast prediction. It's not, something I like to talk about publicly because it adjusts. We do mark that dot to market as things go. So, every meeting for me is one where I want to stop and look at the balance between how we're doing on the inflation side and the unemployment side and make the right decision.
Well, the story around the Fed this week has been, shall we say, the debate over where the neutral rate is. Where do you think it is, and how fast would you want to get there?
Well, I've seen a lot of the stuff that's been in the press, and we're studying that. And, I always try to understand all arguments and figure out how to integrate them into my thinking. I'd point you to the Richmond Fed neutral rate, the Lubric-Mathis model. It takes a lot of signal from what you see in the real economy. And in the real economy, over the last couple of years, what you've seen is interest rates go up and the economy stay relatively healthy. And so that model has a relatively high neutral rate because it takes a lot of signal from the current environment. Now things can change. But that's where the Richmond, Fed model is right now, and I'd point you to that.
What number do they have? Where are you?
It moves around based on what's happening in the economy.
Well, that gets to the next question. Is Chairman Powell saying that you really don't want to target the neutral rate because it moves around? Also saying that for any voter to really move things around, you have to be incredibly persuasive. Do you find Stephen Miron's arguments persuasive?
Well, I'm looking forward to digging into them with my team, and I like every voice in the room and every argument in the room. That's what we do as a discipline, is we sit down and try to take those arguments apart and figure out which parts of them really resonate with the way we think about things and which parts don't. And we're looking forward to doing that.
Is it
on the neutral rate? In general, I just want to agree, it's not that useful as a operational tool. The models out there, even the one that I talked about, have a confidence interval of about 200 basis points. And so you could say it's 3, which is around the SEP median. You could say it's 3.5 or 2.5. But if you add a 200 basis point range to it, you say that's not that helpful for making operational decisions on monetary policy. What is more helpful, and the reason I favor the model we've got in Richmond, is how are you seeing the economy react real time to the level of rates you've got in the market? And if you see it weakening, that's a signal that maybe you've got it too high. If you see it relatively strong, that's a signal the other way.
Lori Logan went to Richmond to announce her idea of changing the operational rate for the Fed. What do you think of that?
Well, I appreciate Lori making the trip. We had a balance sheet conference yesterday that was very well attended, and I thought lots of thoughtful papers, including hers. And I thought she made an extremely articulate, well-reasoned argument, and I'm looking forward to digging into it further.
You anticipate the Fed making a change?
Oh, I don't know.
The Supreme Court, if it allows the president to fire Lisa Cook, what does that mean for the Fed?
Well, the judicial processes and political processes will operate however they operate. What I do every day is show up and try to argue for the best monetary policy we can and make the case, as you said, in a persuasive way to my colleagues. And that's what I'm going to continue to do.
Well, let's leave it with this. What is the best monetary policy right now? Continued rate cuts, or do you not know at this point?
I think you have to be very adaptive to what's playing out here. The world I've described is one where the labor market is weakening. It's a low hiring environment, but the labor supply is also short. And you have to be very attentive to that balance because it could get out of balance, right? Similarly, on the inflation side, you do have these cost pressures and 4.5 years of inflation over target. On the other hand, you're not seeing that show up in spikes in inflation in the real-time numbers. We are seeing what seems to be a productivity boom. And so I think you have to be very attentive to how little we know about how each of our mandate variables is going to play out. And so, I feel like very adaptive is the way to think about it, and that's part of why I'm not being prescriptive into, it's this many cuts over this period of time, because I think we're going to see and learn a lot as we go here.
Stay with us. More Bloomberg surveillance coming up after this.
let's turn back to today's core PCE results. We did see that in-line reading of 0.2% as expected. Ryan Wang of HSBC joins us now. Ryan, thank you so much for being here. It's great to have you on a Friday. What was your takeaway from the data?
Yeah, thanks so much for having me. Well, the data was pretty close to expectations. I do think still it's important that the year-on-year rate of core inflation is getting ever so closer to that 3% level. It actually doesn't matter what measure of inflation you look at, headline CPI, core CPI, either of the PCE measures, they're all running close to 3%. That's not as high as it was a couple years ago, but it's still, of course, significantly higher than the Fed's 2% target.
So are we being gaslit when people say it's just going to keep its downward trajectory? Is this the real reality that we're at a 3% inflation level, and that's probably where it's going to continue, even as we talk about some sort of asymptotic progression to 2% over the next 100 years?
Yeah, well, that's a very good point. And actually, our own projections do have us staying closer to 3% than getting down to 2%, even in the next 12, 18 months. I think that's very much the case. We've heard clearly from Fed Chair Jerome Powell that, okay, you can call tariffs a one-time effect, but that's a one-time effect that can last several quarters, well into next year, maybe even beyond, as the full effect of those tariffs comes through. And, at that point, we have to say, well, what is that going to do to inflation expectations along the way?
So has the Fed basically just accepted 3% inflation without coming out and saying that's our new target, to Lisa's point?
Well,
Have they moved the goalpost on us?
I think this is why you see the divide on the Fed, because clearly inflation is running slower than it was a few years ago, yet it never reached that 2% level. So you're never going to hear any of the Fed policymakers say that, okay, they just reaffirmed the 2% target. They're not going to say that 3% is acceptable. But simply put, I do think it's more likely that we'll be closer to that higher number through the end of next year.
What do you make of the tariff impact right now? And I say this on the heels of last night, us still trying to digest exactly what is going to be tariffed in terms of kitchen cabinets, bathroom vanities, furniture, upholstery furniture, all these new sectoral tariffs the Trump administration announced.
Yeah, well, we're entering Act 2 of tariffs, right? I mean, all the focus up until this point has mostly been on these reciprocal tariffs, but those have had significant sectoral exemptions, and now those exemptions are being filled in as we get these proposed tariffs on these products. So that's just another reason why, the full story of the effect on consumer prices has yet to be felt. And yeah, we're going to be watching really in the rest of the year. It's going to be those sectoral tariffs that I think take most of the airplay.
Just to wrap up a week where we've gotten a lot of commentary, a lot of bullishness on the economy, on the idea of a Fed that was going to be cutting rates even into strength. I'm struck by what Scott Cronert of Citigroup had to say when he was talking about how it feels like there are two different markets. It feels like there are those that are touched by AI and the investment cycle that we've seen, and it feels like there's everything else, which hasn't necessarily been as leveraged to the gains that we've seen in markets, to the gains that we've seen from AI, and the other types of rising tides. And I just wonder how, when you look at this aggregate data, you can parse that out and understand why some people might be feeling really rotten about the pace of inflation and the state of the labor market, while other people feel pretty good and are flying around the world.
Yeah, well, I would say the macroeconomic data do actually bear out some of this characterization that you just said, because really since the start of this year, economic growth, we just got new GDP numbers, will probably be below 2% when this year is done. But we won't necessarily be below 1%. Right. So despite all the focus on the weaker employment growth numbers that we've seen come through in recent months, actually the expenditure data, the GDP data, the output data have held up reasonably well. And I think that speaks to this split where, of course, those that are seeing that hiring activity is slower, those trying to get a job are really being impacted by that softer job market. Prices aren't any lower, regardless of how you're faring in the labor market, right? So again, it speaks to that inflation. But at the same time, company sales haven't necessarily weakened in the way that the most pessimistic views would have thought a few months ago.
Stay with us. More Bloomberg surveillance coming up after this.
A really important conversation. Let's get right to it. Bloomberg News editor-in-chief John Micklethwait is standing by with a very special guest. John, I'll send it to you.
Lisa, thank you very much. We have Kyriakos Mitsotakis, Prime Minister of Greece, here with us. We'll jump straight in. A lot of movement on Ukraine this week. You've had Trump saying stuff about it. You have various NATO allies getting cross about the fighter jets incursioning into their territory and warning Russia about it. You even had Germany coming forward and saying, let's use the 140 billion euro frozen assets to help Ukraine. Now, you have always been a kind of champion of this idea of having a common European fund for defence. And you've always had pushback from the Germans on that. Do you think now it stands a chance of going through?
Well, thanks for having me, John. I've been advocating for quite some time about the need to create some joint European borrowing facility to cover what I consider the quintessential European public good, which is common European defence. And I do sense that there is much more momentum now amongst my colleagues. Some of the countries that were inherently against the idea of additional further joint borrowing have changed their mind. And I'm pretty sure that Germany will eventually also agree to this necessity. And we need to make sure that this facility finances projects of common interest. And I would put missile defense, drone defense right up there in terms of our collective European priorities. So I would expect some movement soon. We have 2 European councils, and hopefully we can make progress towards that direction.
Just looking at the economy at the moment, the Greek economy has been doing very well, as no doubt you will tell me. But in 2024, you forecast a deficit, and then you ended up with a surplus. And this year, you're again forecasting a deficit, but it's quite close to the end of the year. I wondered if now you're close enough to say this year you'll end up with a surplus again for the government.
We've been producing significant primary surpluses, and I think it's quite possible that we may have a real surplus again this year. This is a foundation of our economic policy. We've suffered a lot from not being fiscally disciplined. This is not going to happen again. But I think the big success of our policy is to ensure that the economy is growing at the same time, to create jobs. We've created 500,000 jobs since I became Prime Minister. And the real goal is to ensure that this collective wealth is spread equally. So my focus now is to use whatever fiscal space I can create through growth and tackling tax evasion to cut taxes for the middle class. It's important for me that this discussion is not just limited to the economists saying good things about the economy. I want the average Greek to really feel a tangible benefit from this growth story. And starting January 1st, when these tax cuts will kick in, they will see a real increase in their paychecks. And this is very, very important to me.
We'll just come back to the average Greek in a second. You just mentioned fiscal discipline. You look at the core of Europe. I sat down with Prime Minister Sanchez of Spain the other day as well. Something dramatic has changed. You know, Greece, Spain, you're the countries growing really fast. In the middle, you've got countries in much greater trouble. You look at France, you're growing at over 2%. They're struggling to get to 0.5% of growth. Their debt is ballooning. Are we now in a situation where you would worry about financial contagion from France?
This seemed inconceivable a few years ago. What I can tell you is that eventually no one can beat the markets. We know this very, very well. And I do think that at some point governments have to take difficult decisions to put their fiscal house in order. We've done that. Once you do it, then you can enter into this virtuous cycle where you can actually grow the economy, you can cut taxes, you can support income through targeted measures. We are there, but we also went through very, very difficult periods and very painful reforms. So I do hope that the political situation in France somehow stabilizes. It is important that the core of Europe, France, Germany, that these economies are doing well. Look at, we will receive 36 million tourists this year. Our tourism industry is booming, but if our core markets don't do well, we will also at some point indirectly be affected.
You're a famously polite man, and I know that Schadenfreude is not a Greek word, it's a German one, but there must be some element in Greece of looking at these people who nearly pushed Greece out and thinking, well, things have changed.
Well, things have changed, but at the end of the day, this is not about pointing fingers or about saying that you were wrong and we were right. It's about ensuring that Europe collectively grows. I'm disappointed by the fact that when I look at the Draghi report, we have not made significant progress, and I think it's time that in Europe we usually wear two hats at the Council. We wear our European hat and we wear our national hat, and it seems to me that for some countries the European hat seems to be shrinking. So we have to look at the big picture. Some of the decisions that we need to take require more funding. It's pretty clear. And we need to put our European interest not necessarily ahead of our national interest, but to realize that some difficult decisions need to be taken at the European level.
One of the areas where Europe has been pretty useless at doing these things is banking, the banking union and things like that. Italy's UniCredit has built up a stake in Alpha Bank, which you were famously much more relaxed about than the Germans were when they built up one in Commerzbank. Would you be prepared if they were to take over Alpha Bank? Would you be relaxed about that?
If we really mean what we say about creating scale in banking union, we should be open to these types of transactions. I see value when an important foreign bank wants to acquire a stake in a Greek bank. It means they believe in the potential of the Greek economy. And it means that the bank could possibly do better. I'm pushing my banks to extend more credit to mortgages, to small, medium-sized enterprises. The stronger their balance sheet is, the more likely it is that they will do. So yes, in principle, we are in favor of these transactions. And I'm happy that UniCredit has decided to look at one of our Greek banks and take a significant stake.
Isn't that, but as you said earlier, that's the kind of problem with Europe at the moment. Most people are taking these decisions on, I suppose, purely nationalist or that kind of level. You look around Europe at the moment, the ability to create common things like a banking union, that's the real problem at the moment. Yeah. And do you think that is something coming from Brussels or from the national capitals?
I think most of the important, if you want to understand what's happening in Brussels, look at the national capitals. I think the Council has become more complicated in terms of taking decisions. But on the other hand, in the past, we took a momentous decision when we had to address COVID. Is Ukraine a geopolitical COVID moment? I would argue, to a certain extent, yes. And I remember the COVID fund negotiations. There were a lot of countries, including Germany, that said no until they said yes. So when it comes to defense, which, as I said, is the ultimate European public good, I do expect that we will be able to take important decisions to target specific European projects, which would then again require European collaboration.
You talked a bit earlier about the average Greek. I was looking at the numbers. Greek GDP has come soaring back, but it's still roughly the same level in nominal terms as it was before the crisis, a bit lower in real terms. Is that still, do you think Greece has now been through that phase and it's now the terms of looking forward to a different form of Greece?
We have clearly turned the page, but as I said, if we want to converge with Europe, we need to grow faster than Europe. We've been doing this, but this growth needs to be qualitatively different. It needs to focus on investment, on innovation, on exports, on creating really valuable jobs. And my main goal is to ensure that wages increase, that we have wage convergence with Europe, and that we support disposable income at a time when all European economies are faced with a cost of living crisis. And the only way to address this is to ensure that we support disposable income, but we have to do it in a fiscally sustainable way. That's what we have done so far. We will continue doing it. I do expect that next year we will again, perform very well. So I tell my fellow Greek citizens that I think the best days are ahead of us and that this is a policy that will deliver long-term benefits to them.
You have elections coming up in 2027. The polls at the moment say you might have to go into coalition with people. You've won 2 terms. I think you'd be the first person to get a third term if you did. Would you be prepared to go into coalition if it reached that?
Elections are 18 months ahead, 18 months out. We are way ahead in the polls. Our goal is to win an absolute majority. We've done it twice. There were people doubting that we would succeed before the previous elections. I think that if we deliver on our commitments, and if the economy continues growing, if we work hard to improve the National Health Service, these are the priorities I set out in 2023, we have a reasonable chance to win an absolute majority. But if the Greek people decide otherwise, it's eventually we have to respect their decision.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.